Okay, so good evening, my dear future child accountants. I hope you're doing great. Can you please confirm that my voice is audible and the PPT is visible? Clear. Good. Okay. So after we have discussed about the concepts of theoretical aspects like what do you mean by the word control and what are the exemptions available, we have done some problems also. Now we are looking into the main area, that is proper consolidation. So discussion what we have now is relevant for full-fledged problems, and also the application of these things will be there in other standards. So what are the components of consolidated statements? We have to prepare consolidated balance sheet, consolidated statement of profit and loss, consolidated changes in equity, consolidated cash flow statement, consolidated notes to accounts, everything consolidated. And our main focus will be on consolidated balance sheet. Consolidated P&L account is not going to be too difficult. It's just everything line by line addition. We will do problem anyways. Statement of changes in equity. This is more like a reserves and surplus opening balance, closing balance movement. So we are not going to do anything of this sort. Cash flow statement, we will do some problems. Few special aspects to be discussed. Consolidated notes to accounts, we don't do anything now. Practically it's relevant. Where when you write down all the significant accounting policy notes to accounts, you should give everything consolidated. We are not going to do everything now. So our focus will be priority number one. 95% of our problems will be on, also 90% of our problem will be on consolidated balance sheet. 5% of the problem may be less on P&L and 5% or less on cash flow statement. Okay, so this is our basics. First, so if you understand the consolidation of whole balance sheet, everything is understood automatically there itself. And that's what will come in exam also. And that's what is having connection with other Ind AS. So balance sheet of a holding company you will have. That's what we call it as separate financial statements. They're independent financial statements. Along with assets and liabilities, they will have one item called as investment in subsidiary, and this investment will be accounted as per Ind AS 27, will be at cost or fair value as per Ind AS 109 financial instruments. Now when I prepare balance sheet of a group, what and all it comes? Balance sheet, that is liability of holding company, will go everything. Balance sheets from the asset side of holding company, everything will go. And not only that, the liability of subsidiary company will be transferred, liability of assets of subsidiary also will be transferred. These liabilities and assets of subsidiary basically will be replacing assets and liabilities of the investments. Basically means when you prepare separate financial statements of the holding company, they will have an item called as investment in subsidiary, which is valued as per Ind AS 27. When you do consolidation, you prepare consolidated financial statements, balance sheet of the group, which comprises of assets and liability, assets of holding and subsidiary, liabilities of holding and subsidiary. So basically means indirect way of understanding this investment what we have will be removed, and that what does investment represents? Investment represents the assets and liabilities of subsidiary, which is what is taken to the group. So what are the things going to happen? From the holding company, assets and liabilities will come to consolidation except investment. From the subsidiary company, everything will go to the consolidated financial statements. Why investment will not come? Because that investment only representing these assets and liabilities. What do you mean by investments? I'm having shares of a company. I'm owner of a company, which means what? In the company, I have ownership. So in that company, assets minus liabilities, net assets belongs to me. So after all, investment represents net assets of a company. So investment of subsidiary is taken out. and the subsidiary liability, subsidiary asset is replacing, and that becomes consolidated financial statements. Please write down this simple basics. So, let me know once you're done. Done? Okay, very good. Okay, I'll move further. Okay, now answer me this one basic question. So you will have a vertical format of balance sheet. So you will have a holding company, you will have their assets, you will have their liabilities, and we will have subsidiary company, and subsidiary company will have assets and liability, and we are going to prepare consolidated balance sheet. Simple one. And what we just discussed now, in the holding company asset side, you will have investments in subsidiary, and that will not be coming in the consolidated balance sheet, because that is what is represented by assets and liabilities of subsidiary company. Basically, it's going to be set off, net amount is going to come. Now this is important. Everything will come, assets of holding company will come, subsidiary company will come, those things are fine. Please pay attention, this one essential element is important. Suppose holding company PPE is 1000 rupees, entire 1000 will come in consolidated balance sheet fully. Same thing, liabilities. Subsidiary company has got PPE, furniture, fixture, building, their value is, let's say, 100. How much of that will come in consolidated balance sheet? For example purpose, let's say holding company has 80% shareholding of subsidiary. So now the question is, how much will you take in consolidated financial statements? Will you write PP from a holding company 1000 will come? The subsidiary company PPE, will you take 100, or subsidiary company PPE, will you take 80? Which one is appropriate? What do you think? $100. Okay, but why do you think 100? You don't own 100% of subsidiary, you own only 80%. The group has got 80% shares in the subsidiary company, so you should reflect only 80, isn't it? How can you show entire 100%? What do you think is the reason? Your answer is right. We will show PP of this 100 will become 100. Yes, PP of subsidiary 100 will become 100 only. But my question to you is, why 100? You don't own. What is the logic behind showing 100 even though you don't own 100? Can you think of that word? Your answer is right. It is 100 rupees. Entire assets, 100% subsidiary company assets are consolidated irrespective of the holding by holding company. Either 80% full consolidation, 60% full consolidation. But to what extent do you think it's logical? You're already telling, I'm also telling the answer is right. What do you think is the base? What is the reason for including entire hundreds? The reason is the word to be addressed is control, not the word ownership. The word control. With 80% of the shares, you have the power to control the operations of subsidiary. You control how it should be operated. You may not own it, but you control it. Simple example we are going to learn in days 116 leases, where we tell you don't own the asset but you use the asset. Okay, then show it as in your assets because you have the control of use. They say right of use. So because the holding company controls subsidiary entirely, that is why it is the word control. If they don't have control, subsidiary relationship itself is not there. We spent 2 classes only on that control, understanding the aspect. So entire 100 is consolidated even though it is not owned. Now we come to one more interesting aspect. Now in the consolidated balance sheet we will write 100. Now how much this investment will represent? When you write down, when you set off, how it set off, we're going to write it later. What is going to be the ownership? The ownership of the holding company, the equity of holding company, see, this 100 will come fully, that is fine. Now, subsidiary will have equity. Equity means share capital plus reserves and surplus, okay? Equity will be there. How much that will consult balance sheet? Entire 100 will not come. We write only 80 because equity represents ownership. It's here equity we don't talk about control. Here equity we talk about ownership. We write only 80. So on the asset side 100 will come. On the liability side ownership element 80 will come. 20, there is a balancing figure which is not tallying the balance sheet. That 20 is called as non-controlling interest. Non-controlling interest. Now asset side will come 100, liability side will come 80 and balance 20 will come additional item by way of non-controlling interest because holding company don't own it but control it. It's a beautiful situation. Holding company don't control. A holding company controls, or the group. We don't say holding company, let's say group. Group controls but don't own. You control but you don't own. For example, you are doing some business, you wanted some money, you asked your friend. Your friend told on one condition, I want a share in the profit, I don't want interest. Okay, you agreed, he gave you loan, you're doing the business. In your business, will he come and ask what you're doing, what you're doing? He will not ask. What is his requirement? Profit share should be given. That's all. So, his money, you are using it. So, with his money, you buy the assets, you control how the business should be managed. You control the operations, you control the assets. But ownership, you also are the owner, your friend is also the owner. They are called as non-controlling interest because they don't control, you control. So ownership but not controlling is called as non-controlling interest. So group controls but don't own, that is what is called as non-controlling interest. It's also called as outsider shares. Outsider share because they are outsider to the group, but they are also shareholder. Outside to the group. Outside to the group. But still owners only. But still they are owners. Still they are owners. So in the balance sheet, in the consolidated balance sheet, a new element will come, that is non-controlling interest, the assets which are owned by outsiders but not controlling them, or other way around, group controls them but they don't own. So asset side we take full, liability side one gap is there which group is not owning, and that element is called as non-controlling interest. I hope you are able to get that point of NCI. In AS21, we use the word minority interest because it's less than 50%. They say minority. But in Ind AS, you understood? A person with 40% can control the asset. A person having 60% need not control the asset. 3 conditions of control to be satisfied. So a 40% can be called as control. A 60% can be called as not control. So you can't call 60% minority. So Ind AS uses the word controlling interest, that is of the group holding, and remaining percentage are called as non-controlling interest. But for the purpose of full-fledged problem, you don't worry about it. As long as you are having more than majority, then only full-fledged problem consolidation is done for exam purposes. Practically, we have discussed so many problems where even with less than 50%, by looking at the facts of the case, we can decide whether the person or the entity has control or not. Please write down these things, small points. Group controls but don't own, called as non-controlling interest. Outsider share, and they still are the owners. That's why in the balance sheet, you know what we're going to do. Share capital one line, reserves and surplus, we say other equity, and we say third line, non-controlling interest. So non-controlling interest will also come under shareholders funds because they're outsiders, shareholders. But under AS21, the reporting is they come below equity, above non-current liability. For a minority, a special status have been awarded. In India, we always do. For minorities, we give special status. In balance sheet also, AS21 gives special status. So as per AS21, 4 items will be there. Shareholders funds, non-controlling interest, non-current liability, current liability. But under Ind AS, only 3 headings. Equity, non-current liability, current liability. Under equity, we will give one more line. Equity share capital, then we will have other equity, and then we will have non-controlling interest. And I'll give a format. All those format we'll be discussing before we go to full-fledged problems. Don't have any worries about it. Hope you are clear till here. Any doubts, any questions? Shall we go further? Take a moment, just visualize what's happening because so many things will come in consolidation. Okay. Okay, let's start the story fresh. In the sense, on the date of acquisition. On the date of acquisition. Please tell me which standard applies, which Ind AS applies on the date of acquisition. Which Ind AS to be applied on the date of acquisition? Ind AS 103, correct. So Ind AS 103, right? Ind AS 103. Now let's understand what and all will happen on the date of acquisition in the books of holding company, in the books of subsidiary company, and in the books of group. Okay. In the books of holding company, what journal entry you will pass? That entry is like a normal entry. I purchase shares of TCS. What entry do I pass? What entry an investor pass? Regular entry will be passed. Please tell me, what do you think is the entry to be passed by the holding company's books? Simple entry only. Don't get complicated. You are aware of it. A simple entry to be passed by investor. What entry will be passed by investor? Simple entry. They will have investments in shares of subsidiary company, account debit to bank. That's all. Investment account debit to bank. A simple thing. No complicated stuff. No complicated stuff. Simple entry, investment account debit to bank. Now, can you please tell me what entry do we pass in the books of subsidiary? What entry do we pass in the books of subsidiary? That is in the books of investee. When you buy the shares of Infosys, what will Infosys will do? When you buy the shares, what will investee will pass an entry? Generally, there is no entry because they would have already passed the entry at the time of issue of shares. If it was an initial issue, yes, they will pass an entry, bank account debit to issue of shares, to share capital, to security premium. But if this company, this holding company buying the shares, usually buy the shares from existing shareholders. So in the books of subsidiary company, you will not have any journal entry. Now in the books of the group, they are already having holding company. They need not do this. So now they have acquired subsidiary company. What journal entry they are going to do in the books of group? They don't write investments because group don't have investment. Group owns the asset and liabilities. So we write assets of subsidiary, account debit to liability of subsidiary to bank, or you can say to investments. Instead of writing to bank, you can say investment, but pure entry is to bank. Please observe what a holding company will do: investment account debit to bank. But what will group do? They don't recognize investments. They write assets account to liabilities to bank. Assets account to liabilities to bank. Okay. Now, what should be the value of these assets and liabilities on the date of acquisition in the books of the group? Now, one more thing will come. Suppose assets of the subsidiary company is let's say 100 rupees and liability is let's say 20 rupees. So effectively 80 rupees, and you have acquired let's say 70%. That means will you pay 80 rupees fully? You don't pay 80 rupees fully. You pay only 70% of it. So what about the assets and liabilities not owned by the group? We just discussed now asset and liabilities. The net assets not owned by the group is going to be called as NCI. NCI. So here we write 2 NCI. One more element will come. Give me a moment. I will tell you that with the logic. With the logic, I'll tell you. Okay. Now, please look into this. Now, in the books of subsidiary, I will have a simple T format of balance sheet. Okay. Now, I will have simple as, let's say, PPE. PPE becomes, let's say, they have PPE worth, let's say 2000 rupees. Now, when this is taken, this is as on date of acquisition, okay? In the books of subsidiary, this is already existing book value, 2000. But on takeover, this 2000 value, any idea at what value it will be taken over? Do you think it will be taken over at 2000 or it will be taken over at fair value of PP as on date of acquisition? This is carrying amount, book value. Okay, here we have to apply Ind AS 103. So what does Ind AS 103 say here? When you take over, subsidiary will have their books of accounts whatever they want, but when the acquisition happens, the group opens the books by acquiring subsidiary company, this PPE shall be taken over at fair value basis. Shall be taken over at fair value basis. The standard says, as per Ind AS 103, all assets and liabilities to be taken over or recorded. All assets and liabilities of the subsidiary company, basically the acquiree, the transferor, assets and liabilities of subsidiary recorded at fair value on the date of acquisition. As per Ind AS 103, on the date of acquisition, all assets and liabilities should be taken over at fair value. So when you record in the books of the group, assets will be recorded at fair value, liability will be recorded at fair value. So everything is taken over at fair value. Now, suppose, please observe, suppose all the assets of subsidiary company amounting to, let's say, I'll just write under subsidiary only. Assets under subsidiary, let's say it is 1000 rupees. Liability, let's say it is 200 rupees. So you have net assets, which is 800 rupees, considering fair value. And holding company has, let's say, 80%, 70% shares are acquired. Let's say 70% shares are acquired. Now, please tell me this. Please tell me this. Assets are at fair value. Liabilities are at fair value. Net assets, asset minus liabilities, net assets comes to 800. 70% shares are acquired. So, holding company, how much will they pay? Or how much should they pay for the acquiring the shares of subsidiary company? What should be the purchase consideration? How much do you think they should pay ideally? Assets fair value 1000, liability fair value 200, net assets 800. Net assets 800 should they pay? They are not acquiring full 800. They are acquiring only 70% of the shares. So how much should be the amount to be paid to the shareholder to acquire 70%? %70% of 800, 560. Absolutely right. but you will pay little bit more always, because these assets are what is there in the books, fair value taken. Liability in the books, fair value taken. But there is one important asset which is not there in the books, which you have to create now. You know what is it called as? That is goodwill. Goodwill. Because subsidiary company, when they did the operations or still doing the operations, they would have generated goodwill, brand name, over a period of time by doing business. But can you show the goodwill in the books of accounts? No, both as per AS and AS. Internally generated goodwill cannot be reflected in books of accounts. So what goodwill can come in the balance sheet? Only purchased goodwill. Why? Because only at the time of purchase goodwill will be valuable. A measurement can be done. A reliable measurement can be done. So only purchased goodwill are allowed. So as far as the subsidiary company is concerned, the goodwill is not yet realized because they have not got any money. Shareholders have got it, but group has paid it in the form of two bank. Group has paid. So here you are going to write one more entry, that is called as goodwill. So in the books of the group, let's focus now onwards in the books of the group. Let's pass a journal entry afresh. If you want, you can take down this part. I'll give you 2 minutes. I won't dictate anything. Whatever you have to take it down, whatever I have to dictate, I'll do fresh. These are workings. Whatever you want, you can write it down. If you have any doubts, please ask. And how do you calculate goodwill? You are supposed to pay 560 as per this calculation. But if you pay 565, let's say, the extra 5 what you paid is going to be called as goodwill. Is it done? Shall I take it out? Is there a concept of capitalism in Ind AS? It is there. They will not use the term directly. Under various circumstances, we will do some analysis, but the term capital reserve exists. Very rare, exceptional, but exist. Okay, so I hope you got the important aspect, that is the concept of group. The consolidation is not done in holding company, is not done subsidiary, it is done in group. That one thing, get it very, very clear. It is done in group. So in the exam also, they'll give you holding company balance sheet, subsidiary company balance sheet, and you have to prepare the group. Okay, hopefully you got it. Okay, I'll go further. Hope you have taken it down. Okay. So let's start fresh. On the date of acquisition, in the books of group. What is going to be the journal entry to be passed? Assets of subsidiary, to liabilities of subsidiary, to NCI. This assets minus liability represents net assets. So to bank, and outsider shares to NCI. And balancing figure you can say that is goodwill. And this assets and liabilities should be at fair values. Should be taken out at fair values as per Ind AS 103. As per Ind AS 103. Okay, so now goodwill calculation, how do we do it? Okay, same thing, only I'll take it. The example I gave you, 80% of net assets is what is supposed to have been paid, but you would have paid more in the form of bank. That's what is, I will say, investment or purchase consideration. So I'll compare the amount of investment I made and the amount of net assets acquired proportionately. So goodwill calculation will go like this. Amount of investments by holding company, that is what is like purchase consideration. If you remember the word in AS 14 terms, like amount paid, purchase consideration. This amount XXX less net assets at fair value, or net assets taken over. Net assets taken over on the date of acquisition. Net assets taken over. And remember, net assets taken over, not full, proportionate amount. Why? Because the amount of investment you made, purchase consideration you made, in my example, 70% is not 100%. You are not acquiring 100%, so you don't pay 100%. So you pay 70%. Net assets also should be only that much. So this difference will give me the amount of goodwill. Amount of goodwill. Now, how do we calculate net assets? Net assets is calculated by the assets taken over at fair value, liability taken over at fair value, minus asset taken over minus liability taken over. That is what net assets. Okay, so assets taken over is assets minus liabilities taken over at fair value. Assets minus liabilities. There is one more method of computing equity net assets. This is asset method. Asset minus liability. Do you know there is one more method of calculating net assets? Liability method. From the balance sheet liability side also we can calculate net assets. Instead of doing asset minus liabilities, we can do one more method in the liability method. Can you tell me what could be that? What is the liability method of calculating equity, net worth, shareholders funds, net assets? All are same name. Intrinsic value method, but I'm asking about a simple format in balance sheet. What are the elements you will take from the balance sheet? What are the elements you will take to arrive at net assets? Don't tell me assets minus liabilities. I just told you now. What is the other method to get the same answer? What are the other elements in the balance sheet I can add to get the answer? Yes, share capital plus reserves and surplus. Same only, no. Asset minus liabilities. Asset minus liabilities plus reserves and same as share capital plus reserve plus balance sheet approach. Hope you know basic accounting equation. Asset minus liabilities, net assets, shareholders funds, equity, owners funds is same as share capital plus reserves and surplus. So net assets can also be calculated as share capital plus reserves and surplus. Now, one small issue here. These assets are fair value in the books taken over and liabilities are fair value. But when you do share capital, reserves and surplus, don't you think it is book value? So a small difference will come. Are you understanding? In case of assets which are taken over at fair value, liability taken over at fair value, but when I do share capital plus reserves and surplus, my fair value is not considered, the impact of fair value is not considered. So here we do plus the fair value adjustment. The difference between the book value and the fair value taken over. Are you able to get the three elements? Share capital, reserves and surplus are as per as per subsidiary company books. But we are calculating in group. In group we are doing fair value basis. As per which standard? As per Ind AS 103. So if I take share capital and reserves and surplus, it only means book value, but we need fair value also to be considered. Book value 100, taken over value 110, extra 10 to be considered. Call it as fair value adjustment. It's like revaluation profits. Book value 120, taken over at 125, 5 rupee revaluation profit. But in which books? Revaluation gain, fair value adjustment. Not in subsidiary books. It is taken in holding company books. Hope you are able to get that point. So net assets can also be calculated by share capital plus reserves and surplus plus fair value adjustments. Why this method is important, sir? Because in the exam, when we prepare full-fledged problems, they will not give you net assets on the date of acquisition. What they will give you? They will give you the balance sheet of holding company, a balance sheet of subsidiary company. Now balance sheet of subsidiary company, using that we have to go backwards and calculate what will be the net assets on the date of acquisition. We have to go backwards. So for that purpose, this will be given. Now, all these discussion are on the date of acquisition. Don't forget that. On the date of acquisition, but when they give you the balance sheet in examination, they'll give you subsequently on the date of consolidation, 1 year later, 2 years later, 6 months later. So, and in that 6 months, we would have done some more profits, subsidiary company would have some more profits. So, when you say share capital, reserves and surplus, fair value adjustments are all on the date of acquisition. Let's be more specific. These are all on the date of acquisition. On the date of acquisition. Share capital will not be a problem. Fair value adjustment also will not be a problem. There is one element with respect to reserves and surplus. You should be careful. Listen to this carefully. When you prepare or when they give you the full-fledged problem in the examination, on the date of consolidation, like after some time, after preparation, after acquisition, sometime later, the reserves, the P&L, accumulated P&L will include some money, some profit after the date of acquisition. should not be considered, or that should be eliminated, then you get this amount. Are you clear? I'll explain once more. In the full-fledged problems, when they give you reserves and surplus in the balance sheet, that includes the profit made by the group after acquisition. But while calculating this net assets to go backwards, that post acquisition, after acquisition profits should be eliminated. In other words, the reserves and surplus what we have, will divide this into two parts: pre-acquisition profits, post-acquisition profits. The reserves and surplus profits as on date of acquisition is divided into two parts: profit up to date of acquisition and profit after the date of acquisition. And which is relevant here? Profit up to date of acquisition is relevant for goodwill, or profit after acquisition is relevant for goodwill? For the calculation of goodwill, profit up to date of acquisition is important. Some people call it as pre-acquisition profits. So please write down this reserves and surplus, to be specifically, it is pre-acquisition profit. Pre-acquisition profit, that is profit up to date of acquisition. Pre-acquisition profit, you can write full also, pre-acquisition profits. So basically, what is pre-acquisition profits? Holding company is buying the shares of subsidiary company where they have already made some profits, and you pay for it, and you pay even more. That's because of goodwill. So pre-acquisition profits is profits belong to subsidiary, but from the point of view of group, the investor. So the question always arises, can a company get profits before it's incorporated? Like here also we are telling, how can you get a profit before you have an investment? They have already made profits. You also had one concept of pre-incorporation profits in your past life. Anyway, they are not required here. I just applied the concept there. There's also one more concept. It's like, can you get the knowledge before you are born? Have you heard of any stories like that, where a person got knowledge before even birth took place, before even is born, before his birthday, before he was born, he had some knowledge? Stories only. I don't know whether story reality, but we heard of it. In Mahabharata, a story called as Abhimanyu. When he was in mother's womb only, he was listening, getting the knowledge how to enter into Chakravyu. You know, how to enter into Chakravyu, but he did not know how to go out of it. He learnt only so much, how to enter. He did not learn how to go out of it. So he lost. You know who are called as modern day Abhimanyus? Who knows how to enter but don't know how to exit? You people, CS students. Easy to enter, difficult to exit. Anyway, so hope you got these concepts. On the date of acquisition, we do goodwill calculation, amount of investment we do, net assets taken over, and net assets taken over can also be calculated by share capital plus reserves and surplus plus fair value adjustment. Why this is required? Because in the balance sheet problems, in the full-fledged problem, balance sheet will be given on the date of consolidation. We want to go backwards up to the date of acquisition. To go backwards, post-acquisition profit to be eliminated, we require only pre-acquisition profits, the liability method. Share capital, reserve surplus will be book value, plus fair value adjustments will give us the assets at fair value and liabilities at fair value. Okay, so let's write one or two sentences, whatever I explained to you only, so that you remember later. Please write down. Note on fair value adjustment. Note on fair value adjustment. Note on fair value adjustment. Okay. As per Ind AS 103, as per Ind AS 103, as per Ind AS 103, assets and liabilities should be recorded in the group. Assets and liabilities should be recorded in the group. Should be recorded in the group at fair value at the time of acquisition. At fair value, at fair value at the time of acquisition. At the time of acquisition. At the time of acquisition. This will be considered. This will be considered for computing net assets and goodwill. This will be considered for computing net assets and goodwill. This will be considered for net assets and goodwill. For net assets and goodwill. Okay, next. However, in examination conditions, balance sheet will be given. Balance sheet will be given on the date of consolidation. On the date of consolidation. On the date of consolidation, which is subject to. Which is subject to. Which is subject to. Not subject to, which is subsequent to. I'm sorry, which is subsequent to. Which is subsequent to the date of acquisition. Which is subsequent to. Which is subsequent to the date of acquisition. Subsequent to the date of acquisition. Subsequent to the date of acquisition. To the date of acquisition. Full stop. Next sentence. Hence, we need to go back. Hence, we need to go back to the net assets on the date of acquisition. We need to go back to the net assets of subsidiary. To the net assets on the date of acquisition. On the date of acquisition. Which is done using liability method. 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 Which is liability method, full stop. Net assets equal to share capital plus reserves and surplus. Plus reserves and surplus. Plus reserves and surplus. Within brackets, pre-acquisition profits. Pre-acquisition profits. Pre-acquisition profits. Plus fair value adjustment on the date of acquisition. Fair value adjustment on the date of acquisition. Fair value adjustment on the date of acquisition in the books of group. 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 Full stop. Next sentence. If subsidiary company also revalued its assets. Of course, they can do only if they provide under Ind AS. However, if subsidiary company also revalues its assets, its assets in its books, revalues in its books, then fair value adjustment need not be done. Fair value adjustments need not be done in examination conditions. Fair value adjustments need not be done in examination conditions. Fair value adjustment need not be done in examination conditions because the fair value adjustment would have been already reflected. The fair value adjustments would have been already reflected in the balance sheet given. Did you get these points? I told you this fair value adjustment, why it is to be required, because this fair value adjustment done in the group books but not in the subsidiary books. If subsidiary books also has been done, that means the balance sheet when you take, this fair value would have been already adjusted. So you need not do it once more. Just for your reference, that's very exceptional case. I don't think they will ask in exams, but we are looking at the all aspects to understand the concept thoroughly. Okay. One simple example I give. Let's see if you're able to calculate the goodwill on the date of acquisition. Let's say the facts are like this. Date of acquisition at the beginning of the year, let's say 1/4/2020. Subsidiary company net assets, I'll tell. Net assets of subsidiary. Let's say 1 lakh. And the holding company acquired, let's say 80%. And amount of payment, amount of purchase consideration, amount of investment, amount of purchase consideration, let's say 85,000. Now, what do you think is the goodwill here? In this case? Simple example. Goodwill is calculated by amount of investments at 85,000 and proportionate net assets (1 lakh) into 80%, 80,000. Therefore, goodwill is 5,000. Okay, now if you look at the journal entry and this calculation, slightly difference is there, because in the journal entry we recognize assets, liabilities separately, that's fine, but we also recognize NCI. So if I want to write the goodwill calculation in the journal entry format, see, amount is going to be same. If I want to write in the journal entry format, how it is going to be calculated? Asset minus liability, net assets minus investment. So this investment NCI taken together. So one more way of calculating, which is what recommended in exam, is this method. We take investments completely fine, and we add NCI. Then we subtract not proportionate net assets, we subtract full net assets. Let's see what do we get. Investment is 85,000. NCI, what is NCI? This is the 1 lakh into 80%. That was the holding company share. So what is going to be NCI share? 1 lakh into 20%, right? Remaining non-controlling interest 20%, 20,000 minus net assets 1 lakh. You get same number, 5,000. Same number, 5,000. So the journal entry method, we just converted this into a working note calculation. Mathematically, can you think how come answer is same in both cases? Very simple. Here we are writing minus 80,000 and here what we are doing plus 20,000 minus 80,000 plus 20 minus 80 only. 20% is added, 100% is subtracted, effectively 80% is only subtracted. Correct. Okay, hope you have taken this example. Now one interesting question here. What did Ind AS 103 told? Whatever may be the book value of subsidiary company, don't worry, while taking over, you take over at fair value. Very good, reasonable, perfectly fine. Now tell me, this goodwill related to holding company share only, or is it related to entire goodwill of the subsidiary company? This goodwill of 5,000, what we calculated, belongs to only holding company share, or does it belong to entire subsidiary company as goodwill? Thinking so much? You already calculated. The answer is in front of you. It is only relating to holding company. Perfectly right. I hope you are clear. You don't have doubts. This 85,000 is the cost of investment made by the holding company. 80,000 proportionate net assets belongs to the holding company. So goodwill also belongs to the holding company. Now going back to our basics. Going back to our basics, do you remember I told you 100 rupees of PPE comes 100 rupee in consolidated balance sheet. For the balancing figure, we call it as NCI. Fixed assets, we are taking full 100%. Current assets, we are taking full 100%, even though you own only 80%. Even though you own only 80%. Balance, what do you call? Balance, you call it as NCI. Now the question arises, when all assets and liabilities are reflected at fair value and full value is taken irrespective of the holding by holding company, and what is not held by holding company, you may call it as NCI. Why not for goodwill also? When you reflect everything at 100% and whatever not owning, you show it in NCI, do the same thing for goodwill also. Goodwill also show entire holding company, entire subsidiary company goodwill, and what is not owned by you, include in NCI. Logical. That is what is given by Ind AS 103. Goodwill can be valued under two methods, the accounting policy you have to follow. This is not there in AS 21. Ind AS provides two alternatives. It is the initial choice you have to make, and once you make now, subsequently you cannot change it. So either you can make goodwill under proportionate method, or you can make goodwill under NCI method or fair value method provided by uh, that is goodwill also valued fair value method provided by Ind AS 103. Now let me tell you how does it look like and why that's going to apply. That we have to discuss now. With this example, with this numerical only, we'll try to understand. Okay, now please tell me here. Subsidiary company. Who are the owners of subsidiary company? Let me write in a fresh page. In this numerical only, you'll understand. Subsidiary company. Who are the owners of subsidiary company? One is a holding company, and other is outsiders, NCI. In our example, a holding company has 80% and subsidiary company has 20%. In this example, holding company. Now 80,000, how much are we paying? Please observe this. Investments, we are writing 85,000. So holding company, amount valued is 85,000. Amount paid, purchase consideration is the amount paid. But NCI, how are we valuing? 20,000. Is it proportionate? Do you think it's logical? Now this 85,000 includes, okay, now tell me why these two numbers are not proportionate. Please tell me. Both are at fair value only. One is 80%, 85,000, but 20% is not 25,000. What do you think is the element which included in holding company 80% valuation but not in NCI valuation? Goodwill. Perfect. Goodwill relating to holding company. This includes goodwill. This 20,000 is only the fair value of assets and liabilities taken over. Fair value of net assets taken over. Fair value of net assets and not goodwill. So what another alternative which we are going to discuss is here also please add their share of goodwill. So what you get is fair value of NCI. So if NCI is also valued at market value terms, NCI also valued at market value terms, this will include goodwill. And that is what is called as fair value of NCI, and holding company includes goodwill. Now when I add fair value, this also includes goodwill now. And thereby we are able to get the full value of goodwill, and hence full goodwill is achieved. Let us write this same example. Then we'll write the theoretical sentence and also the format. So same format I will write. Goodwill calculation. So what we did under proportionate method and what we do under now fair value method. Investments, cost of investments by holding company is at 85,000, and NCI we added proportionate net assets minus net assets, which is 1 lakh, and NCI 20,000. So we got it as 1,05,000. Sorry, 5,000. 5,000 goodwill. So what do we do under fair value method? Investments will take 85,000 The same basis as we have used for investments, I'll use for NCI. Usually in the examination problem, they'll give you fair value directly. For simplicity's sake, let's say number of shares are 80,000, 80%, no, let's say 80,000 shares. So what is the fair value per share if I do? Fair value per share 85,000 divided by 80,000 shares. Assume 80,000 shares, 80,000 shares, 20,000 shares, 80, 20, 80,000 shares. So what do you get? $1.0625 per share. Use the same thing now to value this also. 20,000 into 1.0625. Or divide by 80 into 20, that also you can do. 21,250. So plus NCI 21,250 minus net assets, which is same only 1 lakh. So how much goodwill you get now here? 6,250. 6,250. Is that number correct? Okay. And see, quick verification. So 5,000 represent 80% and 6,250 represent 100%. You can also do 6,250 into 80%, you get 5,000. But that need not match every time. Why? I'll tell you logic later. That need not be always true. What is the reason? I'll tell you later. But as of now, you try to understand this much. But please observe. Why goodwill? How much goodwill increased by? Goodwill increased 1,250. Goodwill increased by 1,250. Why goodwill increased by 1,250? Because NCI increased by 1,250. So when you value the NCI at fair value basis, the increase what you have, that is the goodwill attributable to the NCI, which gets added to the goodwill of the overall entity. Thereby goodwill is also valued at full basis instead of only at proportionate basis. Hope you are taking down this example. We will write the format also simply, don't worry, and we'll write sentence also. I hope you got the logic. Okay, hope you got it. Shall I go further? Any questions? Is it fine? Okay, let's go further then. So goodwill computation format. Goodwill computation format. Two methods. I'm getting question. Why are we adding goodwill to NCI? That's what I just explained, no? when you value on proportionate basis, you are valuing the goodwill belonging to holding company share only. If you want to report goodwill at full value, because holding company is owned by 80%, so goodwill you are recognizing at 80%. But if you want to recognize the balance 20% goodwill, where it will be included, it will be included NCI. And isn't what you do in PPI also example I gave you? Shall I repeat once more? How do we write? PPE 100 belongs to holding company 80, NCI 20. Similarly, I am telling now in case of goodwill. Goodwill, we are writing total 5,250. What belongs to holding company is only 6,250. 6,250. What belongs to holding company is only 5,000. Who owns balance 20%? NCI. So NCI will have the balance 1,250. So NCI is included an element of goodwill attributable to their share of 20%, so that overall goodwill is reported at 100%. If you don't include the goodwill belong to NCI in NCI, then it means you are recognizing only holding company share, which is proportionate goodwill. I'll explain one more way in this case. Now, in the books of fair value of assets and liabilities was 80,000, right? 80,000. But you paid 85,000. Why did you pay more? Because of goodwill element. Now, similarly, if NCI valuation to be done, they also to be valued more. So value of NCI should also include not only what you show in book value of assets and liabilities, but also an element of goodwill. Hope you are able to get the point. We write all this in sentences, but first you get the logic. Then to remember, we'll write it in sentences. Are you clear? Why NCI will include the amount of goodwill? This is an alternative. It's not a compulsion. Okay. So goodwill computation formats. So first proportionate basis. Then full value or fair value basis. Full goodwill basis. So we will take investments by holding company. Then NCI is added minus net assets is subtracted. Difference is goodwill. And what is the difference? This NCI is proportionate of net assets taken over. And this NCI is at fair value. NCI at fair value. Now one thing may arise. Net assets is also fair value only. Net assets, that is assets and liability taken over, assets and liability will be taken over at fair value only. So proportionate net assets means fair value? No, this fair value means market value, like the way investment market value is there. Because when they acquired, they would have paid the market value, which includes the element of goodwill. So you say NCI fair value within brackets market value. Market value. So this you write down goodwill, then you write down the increase in goodwill or decrease. It can decrease also sometime. Increase in goodwill is the increase in NCI. Increase in NCI. We'll write the sentences along with explanation. This is the format for it. Okay, so before that we'll take a break. So take a break and then we'll continue. Okay, then you write down. Then you write down valuation of NCI. Valuation of NCI. This is either recognized at proportionate basis or at fair value basis. Either recognized at proportionate basis or at fair value basis. Accordingly, goodwill is reflected at proportionate basis or at fair value basis. Or at fair value basis. Or at fair value basis. Okay, then write down when NCI is recognized at proportionate basis, it is computed as a percentage of fair value of net assets taken over on the date of acquisition. On the date of acquisition. However, investments by a holding company will be at market value which includes goodwill to that extent. To that extent. To that extent. Okay, next. When NCI is recognized at fair value basis. That is fair value in market terms, fair value based on market value per share, based on market value per share. Which includes goodwill, related to NCI holding, also related to NCI holding also, and hence goodwill will be reflected at full value basis. Goodwill will be reflected at full value basis. Full value basis. Okay, hence write down the conclusion overall. Hence difference in goodwill, difference in goodwill under the two methods, difference in goodwill under the two methods, is attributable to difference in value of NCI. Difference in goodwill is attributable to difference in value of NCI. Difference in value of NCI. Value of NCI. Okay. Just write one more mathematical note, I will say. One more note. Write down basis for valuation of controlling interest and non-controlling interest need not be same. Need not be same. What do you mean by this? Let me give an example. Suppose subsidiary company has let's say 1 lakh shares. Let's say okay, 1 lakh shares, and holding companies acquired for acquired 80% for, let's say same number, let's say 85,000. So fair value of NCI ideally should be what? 85th value per share. If I consider uh, 85,000 divided by 80,000, 1.0625, and this is supposed to be 20,000 shares, right? Remaining 20,000 shares into 1.0625, We got 21,250. It need not be. Why it need not be same? Because a person who is intending to get a control over the company will value differently. A person whose intention is to just be an investor, he will pay a different price. I don't know whether you have learnt in valuation. When person buys controlling interest, when person buys a small lot of shares, valuation mechanism differs. Correct? So person who wants to get the control would be ready to pay, sometimes maybe more, sometimes maybe less, but mostly they will pay more. Why they will pay more? Because they'll be doing like this. For example, Flipkart, a few years back, shares of Flipkart by the Bansal people have sold for an insane premium. Why Walmart paid so much to get the shares of Flipkart? Because they wanted to have a control over the company so that they can compete with Amazon. So they wanted the controlling interest to run the operations to face the competition. So they paid heavy price. So the value of premium, the value of controlling interest will include many elements. Sometimes maybe less also. When company is doing bad, you get the controlling interest. You say, I will manage your company, but I'll pay you less. Is it okay? So sometimes it may be less also. Mostly it will be more, but it can be less also. So it need not be 21,250 because this valuation of need not be, it may be more than 21,250 or less than 21,250. It may be more or less. Maybe more or less. This is because valuation of controlling interest will also be influenced by other factors. Will also be influenced by other factors such as premium for control, marketing, technology, etc. Marketing, technology, etc. Technology, etc. Hence, write down, I don't have space. Hence, proportionate goodwill. Hence, proportionate goodwill will not be a perfect proportionate of full goodwill. Hence, proportionate goodwill. Hence, proportionate goodwill will not be a. Hence, proportionate goodwill will not be a perfect percentage of full goodwill. Will not be a perfect percentage of full goodwill. Will not be a perfect percentage of full goodwill. Hope you understood. Here you can't say, oh, 5,000, 80%, 100%, how much? You can't compute like that. Because the value per share of NCI and value per share of holding company may be different. If other things remaining constant, we'll assume they are equal. But in the exam problem, only when they give you fair value, you compute. Otherwise, you don't compute. Clear? However, under any situation, difference in goodwill, difference in goodwill means under two methods. Difference in goodwill under any situation, difference in goodwill under two methods, difference in goodwill under two methods will be same as difference in NCI. will be same as difference in NCI. Difference in NCI. Okay. Any doubts till here so far? If you have any question, you can ask. Fair value computation will always be like this in exam? No. In exam point of view, fair value per share should be given for NCI valuation. If they have not given, you can do like this one. That is value of controlling and non-controlling both are same. Like this one. But I would recommend from exam point of view, if fair value is not given in the information, don't do fair value method. Simply do proportionate method. AS 21 only proportionate method. Ind AS accepts both. But in examination, look for information. And when they give you fair value of NCI, you can never do proportionate method. Don't tell Ind AS 103 gives me the option, but ICII will not give you the option. So if fair value is given, value NCI on fair value basis. If fair value not given, then do it on proportionate basis. So only the NCI valuation makes the difference. That's what this chart also will tell you. Under both the methods, cost of investments plus the NCI share minus net assets. Under proportionate method, it's recognized on book value basis, percentage of net assets, whereas fair value method, NCI recognized on fair value method. Okay. Very good. Okay. Hope you got the one. Okay, now we have discussed in detail about the initial recognition under Ind AS 103. Now, when I discuss about subsequent recognition, subsequent consolidation will be done as per Ind AS 110. Okay, let's get red heading subsequent recognition and consolidation. That is Ind AS 110. Ind AS 110. Okay, so initial recognition journal entry we passed. Net assets account debit to liability to NCI to bank, and debit is goodwill balancing figure. Subsequently, subsidiary company makes profits. Let's say they make profits. Now, in the books of holding company, again, in the books of holding company, in the books of subsidiary, in the books of group. In the books of group. Now, subsidiary company makes profits. Holding company does not pass any entry. No entry. Why no entry? Because they will recognize only when dividend is received. Until then, they don't pass any accrual income. Holding company will not pass any entry for subsidiary company making profits. If you value investments on fair value basis, fair value change you can recognize, but no other entry here. In the books of subsidiary company, let's assume everything is cash profits. Cash accounts, or let's say bank accounts, or let's say net assets. Various assets gets results. Let's say debtors gets created, creditors also created, various we'll say net assets gets created, like cash, debtors, creditor, etc. Cash is received, debtor is created, creditor is created. This is incremental net assets, okay? Additional net assets, incremental. To P&L account, to profits, to other to reserves and surplus, to P&L, and this will be post acquisition profits. Post acquisition profits. And in the books of group, what entry we are going to pass? This profits belong to the group as well as belong to the outsider. So you know what entry we are going to pass? Net assets, like whatever it is there, this net assets debited to entire net assets cannot be, entire profits cannot be belonging to holding company share. So we write to the holding company share will be transferred to consolidated P&L account. And outsider share is there, that will be transferred to NCI proportionately. Proportionately. So to consolidate P&L account to NCI. So in the books of group, it will be transferred to consolidate P&L account, and it will be transferred to P&L account to NCI, outsider shares. So I hope you observed one thing here, that whether the fair value basis is NCI or proportionate NCI, subsequently NCI will always be credited for the book value profits. Subsequent changes in fair value of NCI does not matter. We'll write that in note. I hope you're able to understand till here. So you can write the nature of NCI. Nature of NCI. Initial recognition. Initial recognition. Initial recognition. At fair value or at proportionate basis. Subsequent recognition always at book value of profits. of subsidiary. Book value of profits of subsidiary. Book value of profits of subsidiary. Third. So if subsidiary company makes profits, what do we do? To NCI. It will get added. If it is a loss, it will get subtracted. So profits of subsidiary, proportionate profits of subsidiary, is added to NCI, and loss, if any, is subtracted, debited basically, from NCI. Subtract from NCI. One question arises here. If the subsidiary company makes loss, 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 and loss, so NCI keeps reducing, 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 reducing. There can be a situation where NCI can become negative. Loss, 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 loss. NCI can become negative. Is there any special treatment if NCI becomes negative? Under Ind AS, no special treatment. Minus number? Sure, minus number. But under AS 21, there is a special treatment. Why? Because we Indians, minorities, we can't take losses. We should give special treatment to minorities. So partnership also is there. Minor partners are not responsible for losses. Like that, here also under AS 21 we have. Under AS 21, if minority interest has a loss, not a loss, if there is a negative minority interest, that will also be absorbed by holding company. So minority interest never reported at minus. And subsequently, when subsidiary company makes more profits, that losses absorbed will be adjusted. And then once adjustments are done, then minority interest also started recognizing. That will be like a income tax loss carried forward set off. So holding company keeps absorbing losses when there's a negative, and subsequently when subsidiary company makes profit, adjust those losses. And then once all profits loss are adjusted, minority interest starts recognizing. That's under AS 21. You need not be aware of it. Problems also will not be asked. Sir, why are you telling this then? Because difference between AS and Ind AS will be there. And also under Ind AS 101, there is a first time recognition, first time transition. These points may come up. Under accounting standard, we are doing like this earlier. Under Ind AS, how do we do? So you need to have a little bit knowledge of accounting standards. So just be aware, negative interest, there is a special treatment under AS. Under Ind AS, there is no special treatment for negative NCI. So if any subtract from NCI, and even if NCI becomes negative, even if NCI is negative, even if NCI is negative. Any doubts? Okay. Now, ultimately now, what should be done in the full-fledged problem? Overall format also let's discuss now itself. Before even we go to problem. So overall format also we'll just discuss. So we'll get the overall picture of it. Usually 90% of the classes, formats, textbooks, faculties I've seen, they follow the stepwise method. Step 1, date of acquisition. Step 2, percentage of acquisition. Step 3, pre-acquisition, post-acquisition. Step 4, minority interest. Step 5, goodwill. Step 6, consolidate reserves and surplus. Step 7, balance sheet. Step 8, go to next problem. Normally, people do the last one only, and they explain like this. Under step 2, you do like this. You'll be like, step 2. What is step 2? By the time you recollect, they would have explained the next topic. So this puzzle game of steps is not convincing enough for a student point of view. Method is beautiful. I'm not denying it, but that is not student friendly. Institute also gives like that. They'll start from this page, note 1, note 2, note 3, and they'll go to 3-4 pages. And you go to the note 5, they'll say refer note 3. You go to note 3, they say refer note 7. You go to note 7, you're wondering which problem you are doing. That's one problem, because you are learning. Consolidation as such is complex. When too many things are there, the structure you will not be able to get in your mind. So you lose the concept. So people lose the confidence in consolidation. So what we are going to do now is everything trying to get in a one single frame. So any adjustment comes, how to fill it up. So that way, any adjustment comes, you will be able to do in one working note itself. At least major concepts can be done in one working notes. What is the advantage of this method? What we do, everything comes in one place. You can understand the interlinkings. It is visible, visually available. You need not imagine, because step 1 go to step 7, step 5, you suddenly become Gajni. You forget what is happening. You don't connect easily. Hope you're able to understand the importance of our format. The disadvantage of our format is, this format is not available elsewhere in the market. At least I've not seen most faculties, most famous faculties at least, don't do it. You will know, and textbooks to know, study material no. So if you have any doubt, you are in a fix. You think that I will ask the doubt in my friend, and your friend will be, I will ask my friend. So this friendship game, you lose the concept. So this format, what we are going to learn, is definitely useful, faster in exams. It is conceptually framed. It's beautiful format, time-saving format, efficient format. But if you have a doubt, you should be careful. So understand the concepts clearly. If you have a missing link, your support system may not be there. It's beautiful, but support system may not be there. And one more important question, do we get marks in exams? Definitely yes. Why? Because it's easy to understand. Anybody can understand the format. Anybody can value easily. They don't have to do rocket science to understand this format. Simple format only. So don't worry about the examination part. You get the answer right, you will get marks. Once you get the answer, then you worry how to present in the exam or not. First, let's understand. First, let's get the answer right, because tallying consolidated balance sheet is one of the happiest moments of CS students. In fact, tallying in anything, and consolidated balance sheet is like top of the world. So all these whatever Diwali you celebrate, highest cracker happiness you will get when you tally the consolidated balance sheet. First, let's get the flow here. Holding company, everything will come in the balance sheet except one item. Some more exceptions are there, we'll look at later. But one element from holding company balance sheet will not come in consolidated balance sheet. Can you tell me what is that? One element in the holding company balance sheet definitely will not come in consolidated balance sheet. One item which will definitely be eliminated. Investment in subsidiary. Investment in subsidiary. Other investments will come. Investment in other companies. But investment in subsidiary companies will not come. That is all with respect to holding company. So holding company is not a difficult one. Subsidiary company balance sheet, that we discuss now. Subsidiary company balance sheet, assets full 100% because control we apply, controlling interest 100%. Liabilities also we will take 100%. Share capital. Where will share capital of subsidiary company goes to? Remember, the moment we come to equity elements, we should look at the ownership of it. Who are the owners of subsidiary company? Two parties. One is holding company is the owner, group is the owner, and outsider is the owner, NCI. So outsider shares will go to non-controlling interest. Outsider share. Outsider share. Now please tell me, where will the holding company's percentage will go to? Group ownership is there, where that will be transferred to, where that will be considered. Holding company's ownership, group ownership in the share capital of subsidiary company, where do you think it will be reflected in? Not getting idea? Look at the previous working note what you have written, you will get the idea. Just refer today's discussion only. On the date of acquisition we have discussed in detail, and for examination purpose how the balance sheet will be given, what you should do also have given. Share capital of subsidiary company. Okay, I'll tell you. Share capital of subsidiary company, when nothing else is given, this will be there at the time of acquisition also. Share capital of subsidiary at the time of acquisition means it is part of the net assets on the date of acquisition, and net assets are used for what calculation? Net assets of subsidiary company on the date of acquisitions are used for goodwill. So holding company share will be used in computing goodwill. This is group share, group holding in subsidiary. Profits, reserves and surplus. When I say profits, I say reserves or other equity. I meant reserves. Now, reserves will be transferred before to these people two elements. One, pre-acquisition profits. Why? Recollect. I told you, when they give you balance sheet, they give you balance sheet on the date of acquisition, on the date of consolidation, which include reserves. This reserves includes profit made before acquisition and profit up to the date of acquisition. Subsidiary company will not know those things. They report reserves as on date. Group should identify, holding company should identify, investor should identify. Investor point of view, the classification should be made before I purchased their shares, how much profit they made, pre-acquisition profits. Profits as on the date of acquisition by the holding company. Pre-acquisition profits. Again, outsider share will go to non-controlling interest. Pre-acquisition profits only we are discussing. Pre-acquisition profits and pre-acquisition profits relating to holding company share will again come to goodwill. You see, two things are coming to goodwill. One is share capital, other is pre-acquisition profits. What is share capital plus pre-acquisition profits? That is nothing but net assets on the date of acquisition. So net assets you got, and one element from the holding company balance sheet will not come to consolidated balance sheet, investment. So that investment and this net assets will be set off. Net amount is called as goodwill. Hope you're understanding the structure of it. Okay, now coming to post-acquisition profit. Post-acquisition profit, outsider share will go to non-controlling interest. Now, what will happen to holding company share? This is interesting. Tell me where. We have discussed just now. Previous to that, we have passed the journal entry also. And we have written a note also. It will be transferred to consolidated P&L account. We discussed journal entry just now, right? Consolidated P&L account, nothing but reserves and surplus. In the balance sheet, we show it under reserves and surplus. That is profit earned after acquisition, which will be transferred to P&L account. And there are sometimes like OCI will be there. Some reserves will directly come to balance sheet. Whatever you call, it will come under reserves and surplus, means other equity. So when I say the word consolidated P&L account heading, don't think only P&L. I talk about cumulatively reserves and surplus. Includes P&L account also. So if you look at this chart, ultimately after all this circus, what are the things which are required? Consolidate balance sheet. Anyway, we are going to prepare in the full balance sheet. That does not require working note. So leave these two parts. We need one working note for non-controlling interest, non-controlling interest, non-controlling interest. We need one working note for goodwill and one working note for this consolidated P&L account. These are the outputs. So these three things, instead of preparing multiple working notes and making a life of circus out of it, what do? We'll prepare these three things in a columnar format. In a columnar format, we are going to prepare. Please take down this flow of thoughts. So this chart, what you have written, is for your mindset, how to think, how to present. I'll give you one more format. This is for your flow of thoughts, how the dots are connected, where which item will go where. Overall flow analysis. And for presentation purpose, I'll give a tabular format. First, you write down this. If you have any doubts, you can ask. Any doubts? Are you clear till here? Okay. So this format now, I am going to convert into a tabular one. This is our Bible now for a couple of days. Particulars, total, goodwill within brackets. I'll tell you why. CONPL or other equity NCI. Subsidiary company, holding company percentage, NCI percentage. Don't write it down now. Let me explain the concept, then you take it down. And while taking down, make sure you write in the fresh page. You write one fresh page only for this format, because so many adjustments we are going to discuss over a period of time. As and when we discuss new adjustments, you keep on updating this format. And not only this format, one more page you leave for balance sheet format. So working note format is there in one place, and balance sheet also is there. A quick revision of entire chapter will happen in one place. Easy to revise subsequently. But balance sheet format I'll not give you now. After all adjustment discussion, we'll come to balance sheet. As of now, let me give you the basic structure of this. Let me explain, then you please take it down. So keep the chart, what we written now in mind. Share capital of subsidiary. We'll go to goodwill calculation. So that is holding company share, transfer to holding company to goodwill calculation, goodwill column. Outsider shares, NCI percentage, NCI column. Pre-acquisition profit, same treatment, because this will give you net assets on the date of acquisition. So holding company shares to goodwill calculation, NCI share to NCI. Post-acquisition profit will not come to goodwill calculation because this was not there at the time of acquisition. This came later. So this will come to CONPL, holding company share, NCI will get their share anyways. Now come to holding company, one element will come in the calculation, will not come in balance sheet, which is investment in subsidiary. Just 1 second. Okay. So investment in subsidiary we have. That amount I am writing within brackets, negative amount. This please pay attention towards the symbols, mathematical part, not conceptual, mathematical. Investment amount I am writing within brackets, minus number. Why minus number? Because share capital, pre-acquisition profit, post-acquisition profit are liability side item. I'm keeping it in positive number. I want to set off with assets. So asset element, I'm writing it in negative number. Negative number. And that amount I will transfer to goodwill column because I'm setting off with net assets calculation. And the holding company will have their reserves, and that will come in the consolidated reserves. That is consolidated P&L account, consolidated reserves. Put together only we report in balance sheet. And we do the total. Total amount may be negative, and total amount. Please pay attention here. Now, when this amount put together, let's say 10,000 and investment minus number 12,000. So net number you get 2,000. Please observe here. When you get goodwill in our calculation earlier, investment minus net assets. Investment 12,000. Minus net assets 10,000, 2,000 goodwill we got. But here I am doing reverse calculation. I am keeping the investment in minus numbers and net assets in positive number. Are you able to understand the shift I am making? Don't worry, I'll make you do problem under both the formats initially. You'll get comfortable. But try to understand at every step. Initially we did investment minus net assets. But here what I am doing in net assets, I am doing first a positive number. Share capital plus pre-acquisition profit is net assets and minus goodwill. So when minus investments, when investment is high, negative number is high, investment is high, that means I get goodwill. If investment is less, that means I am paying less. Positive number will come. A positive number means that is called as capital reserve under accounting standard, and here before you call it as capital reserve, we call it as gain on bargain purchase. Gain on bargain purchase, which is then if you very confident it is in the nature of capital reserve, then you transfer it to capital reserve. But here we don't call it as capital reserve. When you pay less, when you have a profit, when you have a benefit, You acquire 10,000, you pay only 8,000, you pay less, you get more. In that case, the profit was called as capital profit, capital reserve under AS. Here we prefer to call it as gain on bargain purchase, GBP, gain on bargain purchase. Now, before you write down, one more adjustments will come regarding NCI. Now, this goodwill, please tell me, is it goodwill under proportionate method or fair value method? Please answer. What do you think? Is this goodwill under fair value method or proportionate method? This is proportionate method. Why proportionate method? Proportionate method because here we have taken only investments into consideration. NCI has no impact here. So it is goodwill under proportionate method. Now, if I want to do goodwill under fair value method, which element should I change? Please tell me. If I want to value goodwill under fair value method, that is increase in goodwill, difference in goodwill under two methods is attributable to one element. Is attributable to. You heard it in the sentence also. When you want to recognize the goodwill on full fair value basis, what is the other things you are going to change so that goodwill gets reflected? This is goodwill belonging to holding company share. Another one goodwill element included in another element. Where? Which element I need to modify? Goodwill from proportionate to full value to fair value. What is that amount which need to be adjusted? Where need to be adjusted? Which element will get changed? Not able to get it? Please read. Two methods. Market value of investment. No, investment we already done. I'm not talking about investment part. Market value, are right. But what other element gets changed? When you want to value under when you want to value under fair value method, the other element which gets changed is NCI. Correct? Other element is NCI. Now, at this point in time, this NCI reflect what NCI? Fair value in the books, right? But fair value, what we want? Fair value in terms of market terms. So, that difference in NCI, if I reflect it, my goodwill will become fair value basis. Okay, I'll show you the calculation now. Please observe. Difference in goodwill arises because of difference in NCI. If I change my NCI, my goodwill also will appropriately be reflected. So everything is in the hands of NCI. Now, what should be the value of NCI? My value of NCI should be fair value basis. Fair value as per market value, fair value basis. But these two amounts, share capital, pre-acquisition profits, will be as per books. So difference between book value, fair value, if I adjust NCI, my goodwill also will be adjusted. Repeat once more. Goodwill difference is going to be there because of difference in NCI. How much difference? NCI at fair value, NCI at proportionate value. What we have now in this column is NCI in proportionate amount. If I compare with NCI in fair value terms, difference if I do adjustments, NCI will be reflected in fair value and goodwill will be reflected in full value. So I need to do adjustment to NCI and automatically one adjustment in goodwill. Hope you got the concepts. Now, please tell me this. For proportionate calculation, which of these three amount will consider? For proportionate NCI calculation, will I consider 2 or will I consider all the 3 elements? For proportionate NCI calculation, which element will I consider? I will consider only first two, right? Only first two will be considered because post acquisition come later. We are doing this calculation at the time of acquisition. NCI fair value adjustment, goodwill calculation at the time of acquisition. So these two amounts will give you proportionate NCI. Proportionate NCI. And you compare this with fair value NCI. Fair value of NCI, that amount you adjust it in NCI column as well as goodwill column. I call it as NCI adjustment. This is not there in textbook. This is my introduction for this format. My format will be reflecting NCI at proportionate NCI basis. If I want NCI at fair value basis, I need the differential amount, which I am calling it as NCI adjustment. Now, what should happen to this? Suppose, please observe this. Fair value of NCI is, let's say, 10,000. My proportionate NCI is 8,000. Now, NCI column, what should I do? Please tell me, should I do plus 2,000 or minus 2,000? And it's very simple, but I know people gets confused here. Suppose fair value of NCI is 10,000 and our proportionate NCI happened to be this plus this 8,000 coming together. Difference is 2,000. That is NCI adjustment. Tell me in the NCI column, will I do plus or will I do minus? You do minus. You do plus. Don't change your answer based on my reactions. What do you think? Simple answer only, but sometimes people can get confused. Plus only, right? Plus only, very good, plus only, correct. Why? Because presently it's showing 8,000. It's showing 8,000. So you want to make it to 10,000, you do plus 2,000. Current column is having 8,000. You want it to be 10,000, you do plus 2,000. Simple mathematics. Simple mathematics. Here comes the picture. Tell me, what will you do in goodwill? What will you do in goodwill? Goodwill column. Because that difference should be now reflected in goodwill. Will you do plus or will you do minus? Here people do mistakes, I know. Okay, here please observe. I will tell you method where you don't do mistakes, but I'll do that later. But as of now, learn conceptually. Now, when the fair value is high, in this example, fair value is high, what will happen to goodwill? Please tell me. When my fair value of NCI is high than proportionate amount, the excess represents goodwill. So now you please tell me, when the fair value increases, fair value of NCI increase, what will happen to goodwill? What do you think? Under proportionate goodwill will have some number. When you recognize the goodwill also under fair value, what will happen to your goodwill under proportionate method? That will also increase. That will also increase. That's what we discussed. No, increase in goodwill is attributable to increase in fair value of NCI. Now, please look at my goodwill is in negative number here. My goodwill is in negative number here. My negative number should increase. It is like my investment now. We are reflecting just like investment includes goodwill. Now this fair value should include goodwill. So if my negative number should increase, under this goodwill column, it should be minus 2,000. Okay, this is full of logic. Simple technique. What is the simple technique? You do plus in NCI column, minus in goodwill column. You do minus in NCI column, you do plus in goodwill column. That's all you have to remember. Now the question is, when will you add in NCI column? When the fair value is high, you do plus in NCI column. Opposite you do in goodwill column. When the fair value is less, In NCI column, you subtract. So you do subtract in NCI column, you do plus in goodwill column. Just the opposite. Logic I told you, technique is simple. We'll write the technique. So as of now, first, but most probably it will be plus in NCI, minus in goodwill, because fair value will be high. Mostly, not necessarily. Anyway, so you please write down this format. Leave enough space. Some 7-8 lines, 4 lines here, and 3-4 lines here. Leave full page. Write the full page and leave these blanks, because we have to fill up later for other adjustments. Write down the format. Any doubts you can ask. Now NC adjustment comes only when the problem says it. That's why it's in red color. So we can put one star. Only when they say you do this adjustment NCI under fair value. Otherwise, if the question does not say NCI fair value, don't do any adjustment on this. This line item will not come. So you please write down then, these two amount represents proportionate NCI. And one more line item will come later, fair value adjustment. That also will be on the date of acquisition only. That also will take it. Proportionate NCI. Sometimes I'll also call as book value of NCI. Both are same. But for convenience, let's say proportionate NCI. That is more technically correct. Let me know once the format is done. Please make sure enough space is available. The format is very nice, so learn it properly. Hope it is fine. Let me know once the format is done. Write slowly, no problem. But make sure you get the concept clear. Leave enough space. One full page for this format. One full page for balance sheet. We treat it later. As and when we learn any new adjustments, we'll keep updating this format. Can you explain investment in subsidiary, positive or negative amounts? Investment in subsidiary is always negative amount. The reason is, in this format, liability items like share capital and all, I am showing in the positive signs. Investment, I am showing as investment is an asset item. So one liability item, one asset item. So asset item I am showing as negative number. Our previous format for working note calculation, goodwill calculation, even institute formats and all, what they do investments minus net assets, investment plus NCI minus net assets, investment minus net assets. In our format, what we do, it is net assets with the share capital plus pre-acquisition profit minus investment. So we are just reversing the format. Investment is a asset item, so I'm showing minus to do a set off. How many lines for holding company? Maybe 4-5 lines. 4-5 lines. One more item for impairment will come. One for maybe debenture, and one for maybe unrealized profit. Maybe totally 5 lines. 5 lines is sufficient for holding. Leave the more space for subsidiary. 5-6 line maximum for holding. Remaining for subsidiary. Is it done? Any other doubts? We'll write a note on this one. NCI adjustment only. Okay, so please write the note on NCI adjustment. Please write the note on NCI adjustment. NCI adjustment is the difference between, or let's write the formula somewhere. NCI adjustment equals to difference between fair value minus fair value of NCI on date of acquisition minus proportionate NCI on the date of acquisition. Proportionate NCI on the date of acquisition. And proportionate NCI is calculated by share capital, again everything proportionate, plus pre-acquisition profits plus fair value adjustment. Fair value adjustment. So share capital plus pre-acquisition profit plus fair value adjustment So any item which is post acquisition not considered, which is post acquisition is not considered. Okay, now the question comes when to add, when to subtract. So write down, if fair value of NCI is high, that means if the result is positive number, if fair value of NCI is high, then add in NCI and subtract in goodwill, subtract in goodwill, so that both are increased, so that both are increased. Please pay attention to this word, both are increased. We are subtracting goodwill, even then it is increasing. Why? Because goodwill is already within brackets, investments within brackets, so goodwill is within brackets in our format. So when it is a minus number, you bring in one more minus number, goodwill will increase. Conceptually, so it should increase. Why? Because when fair value of NCI is high, why it is high? Because of the goodwill element. So goodwill element we need to increase. That's what we are doing, but we are increasing by putting subtraction. By subtracting, we are increasing. Hope you are able to get it. So it's a sentence. Everything you lose in your life not necessarily is bad for you. You lose anger, you lose bad thing, it is good for you. So when fair value of NCI is high, fair value is added, to the NCI column, and the difference, NCI adjustment is added in the NCI column and subtracted in the goodwill column, so that both are increased. And what you add? Not fair value. What you add? The NCI adjustment. That is added. Difference. NCI adjustment. That is what is added. NCI adjustment. That is what you need to add. Don't add in fair value itself. That's one more mistake people do. If fair value of NCI is negative, in the sense fair value of NCI is less than the proportionate NCI, then what we should do? NCI adjustment subtract in NCI column and add in goodwill, so that both are decreased. Both are decreased. So when NCI fair value is less, we are already having in our column proportionate NCI, share capital plus the reserves and surplus, pre-acquisition profit and fair value adjustment on the date of acquisition is already high. Fair value less, so this should be brought down. So I subtract the NCI adjustment, so my proportionate will come to fair value level, and the minus number will become plus number in the goodwill column. Why? Because goodwill column is having negative goodwill. We want to reduce that. Reduce the negative number should be reduced, means it should be plus, so that both are decreased. Okay. So this is the conceptual discussion of overall format. Many adjustments are there. Like we have to do so many adjustments. Adjustments like revaluation profit is there, depreciation is there, unrealized profit, impairment of goodwill, dividend adjustments, multiple acquisitions, chain holding, multiple acquisition then sale, numerous adjustments, investment in debentures, preference shares. So many adjustments are there. But before we go to the main adjustments, let's our foundation be stronger with this one. Once you are comfortable with this, any new element we can keep on adding it. Hope you are comfortable till here.